All right, welcome to video number 7. This is on ESG analysis, valuation, and integration. And this is also the meat and potatoes of the CFA ESG. This goes to the core of what the certificate is all about. You are the investment analyst. You need to evaluate ESG risks for a company and figure out how to incorporate those risks in your valuation model. If your fundamental research company value and share price, then how strong of an impact will an issue stemming from a ill-defined governance structure be, for instance? How should you incorporate the looming potential of a policy change regarding water pollution that may affect the company you're analyzing? If there's doubts about whether ESG investing is in line with fiduciary duty, questions like these prove that it is. A fundamental analyst must understand these risks, no matter his view on sustainability or climate change or other policy issues. But he needs to understand the material risks that, prior to make an investment in a company. I recommend you to read this chapter at least twice, if not 3 times. The chapter begins by explaining why investors integrate ESG. There are many reasons why it makes sense to integrate ESG. For one thing, if you want to know what risks you associate with your investment. It can also be client-driven. It can be driven by a desire to lower reputational risks at a firm level. Then one big topic is the topic of fiduciary duty. Since for the past decades it had been contested whether integrating ESG factors would be detracting returns or not. The argument is being settled with analysis done by the UNPRI and the legal firm Freshfields, which suggested that fiduciary duties include integrating ESG into the analysis and the decision-making process, encourage high standards of ESG performance, and incorporate beneficiaries' sustainability preferences. So that settles it. The chapter shows the results of an interesting survey that explains the reasons some firms adopt ESG factors, also showing the regional differences. The chapter next talks about the ways ESG analysis can be done, quantitative or qualitative. And then once the analysis is done, it can be incorporated again qualitatively or quantitatively, or a mix. So there are some natural tendencies that qualitative ESG analysis is probably conducted more by fundamental analysts, and quantitative ESG is done more by quant strategies which use systematic models. Because there are various ways to combine the approaches, for instance, qualitative analysis to produce scores, then are incorporated in a quantitative way, CFA has dedicated one entire subchapter to clarify the confusion around this issue. They distinguish the word quantitative from the word systematic and use systematic to describe approaches that run on very little human actions like high-frequency trading, trend following, risk parity, and other systematic approaches. One of the most important topics in the chapter is on tools of ESG analysis. Be assured to understand these. So we've also have them here on the slide. Things like red flag indicators, company questionnaires and management interviews, checks with outside experts, watch lists, internal ESG research, which includes materiality frameworks, ESG integrated research notes, research dashboards, strength, weakness, opportunities, and threats, SWOT analysis with ESG factors, scenario analysis, relative rankings. Those are the internal research, the internal ESG research. Then the external ESG research, which includes sell-side, ESG specialists, third-party databases. And then the last point is the ESG agenda items at investment committees. Once you understand what the tools are, you need to understand how these elements may be integrated. For instance, adjusting forecast financials like revenues, operating costs, asset book value, capital expenditures, adjusting valuation models or multiples like discount rates or terminal values, adjusting credit risk and duration, managing risk, including exposure limits, scenario limits, value at risk models, ESG factor tilts, ESG momentum tilts, strategic asset allocation, including thematic and ESG objective tilts, tactical asset allocation, ESG controversies, and positive ESG events. Then the curriculum also provides the ESG integration framework. Now be sure to understand the graphic quite well. So you will see that's a graphic that shows all kind of ways to analyze ESG across the different asset classes. It gives you almost all options of how you can integrate ESG in each asset class. Even if ESG factors are not formally embedded in the investment philosophy, investment teams may still use ESG techniques in their approaches. There are typical stages of integrated ESG assessment. One is in the research and idea generation stage, the analyst would gather information from multiple sources and conduct materiality assessment to see if ESG issues have an impact on the company's financial performance. It is usually assessed in terms of likelihood and magnitude of impact, and the curriculum provides the difference between tangible assets like inventories versus intangible assets like intellectual property. ESG issues can affect both types of assets. Then the generating ideas stage shows how investment ideas can be derived from ESG. Perhaps you want to avoid a low G ranked stocks, or seek a high G ranked stock, or capture the alpha expected to arrive from improving G, so playing the momentum plane. Ideas could also be identified in themes that tackle a larger megatrend affecting large populations, things like improving access to clean water. One way to visualize analytical inputs is by creating scorecards. There is a process for developing scorecards, and that goes like this. Number one, identify sector or company-specific ESG items. Then break down issues into a number of indicators. Determine a scoring system on what good and best practice looks like for each indicator and issue. Assess a company and give it a score. Calculate aggregated scores at issue level, dimension level, or total score level, and then optionally benchmark the company's performance against industry averages or peer group. The curriculum then further explains materiality assessment and risk mapping. Again, not all risks are material and not all can be managed. There are two types of material non-managed ESG risks, and these are, number one, the unmanageable risks, which cannot be addressed by company initiative, and then the management gap, which represents risks that management has not yet addressed. Then the next chapter addresses how once identified, these risks can be integrated in the valuation of a company. The research conducted can lead to adjustments of forecast financials, valuation model variables such as cost of capital or terminal growth rates, valuation multiples, forecasted financial ratios, internal credit assessment, assumptions in qualitative or quantitative models. The chapter describes these techniques quite in detail. Make sure you understand the differences. It also explains how ESG analysis can be complementary to traditional financial analysis. One important challenge ESG analysts or financial analysts who incorporate ESG face is disclosure on ESG topics by companies. There are a variety of disclosure policies and reporting, but disclosure on ESG is often not compulsory. So there is a large flexibility as to what management may report. And then, The other problem is also there are firms who over disclosure, they share too many ESG information that makes it difficult to kind of understand which ones are material and which ones are not. But simply because a company does, for instance, not disclose their approach to ESG doesn't mean that it has more risks or that it's trying to hide something. It can be the case that the firm simply does not have the resources to employ people who produce data and reportings on this subject. That said, a lack of disclosure may be an indicator of poor management. Data may also be unaudited, discontinued, or incomparable to other companies. The chapter then continues with case studies and examples of how asset managers and asset owners have incorporated ESG in their investment decision-making process. These are great to illustrate the varied ways this broad subject can be taken into account. And the rest of the chapter talks about differences in integrating ESG in the various asset classes, private markets, real estate, fixed income, equity, as well as the challenges to ESG integration. Within fixed income, there is a difference between corporate bonds and sovereign bonds. Incorporating some of the factors associated with sovereign bonds is quite difficult. Taking credit or equity KPIs doesn't really work, because for sovereigns you would look at things like peace, corruption, ease of doing business, freedom of expression. So in terms of the biggest challenges, a lot of centers around data. Disclosure and data-related challenges like data consistency, data scarcity, data incompleteness, lack of audited data. Comparability between ESG rating agencies, countries and cultures, terminology. Materiality assessments are subjective. Those are kind of the biggest challenges that pertain to ESG data. Then another big issue is that in investment firms, a significant part of the staff still does not believe in ESG. That can be a reality. This has a lot of ripple effects. For one thing, if senior management does not believe in it, it will be unwilling to add resources to the cause of ESG. So may not employ ESG analysts, for instance. And even if a firm adopts ESG, there may still be criticism that, for instance, the firm may be too inclusive of poor companies, dubious or very vague assessment criteria, the quality of data still, potential lack of emphasis on long-term improvements. So, who can analysts go to receive ESG data? There are different kinds of companies who do that. There are for-profit large providers like S&P or MSCI. Then there are for-profit boutique providers like RepRisk, and then they can also get data from non-profit providers like the World Bank and others. And in terms of services, this is typically what they will be offered. From these firms, it's ESG data, ESG ratings, ESG screenings, voting and governance advice, ESG benchmarks and indexes, ESG news and controversy alerts, integrated research, advisory services. Another key issue is that there is a large divergence with regards to ESG ratings. One firm may see a firm positive in one light, while another may emphasize the poor firm's performance in another aspect. This gives mixed signals to the company as well as to the investor. This is quite different from credit ratings, which usually walk in lockstep and have a high correlation. Sustainability ratings can also be given to funds and fund managers, as done by Morningstar. Morningstar covered more than 20,000 mutual funds and more than 2,000 ETFs, and gave ranks from 1 to 5 with regards to their ESG integration. Other two providers for rating funds are Mercer and Real Impact Tracker. Then in terms of company data, so not fund data, but company data, the two largest providers are Sustainalytics and MSCI. And in terms of index providers, the largest ESG index providers are FTSE Russell and MSCI. The chapter then ends with a discussion on fixed income and credit rating agencies and the connection to ESG factors. Now, as you can see, very broad topic. Important to understand is that this chapter tries to explain how to find, evaluate, incorporate ESG data by different asset classes. Then it also talks about the many service providers, including index providers, ESG rating providers, and so on. This all, again, from the lenses of a financial analyst. So as I said, we're not going to give the 5 most important topics because this chapter is simply too big to distill it down to 5 topics. We recommend you read it at least twice, if not 3 times.